Inflation is finally slowing down after a relentless surge. But why does everything still cost an arm and a leg? You're not imagining it. Prices really aren't coming back down to earth. In fact, they may be stuck at these dizzying heights for the foreseeable future. Want to know the deeply unsettling reason companies are keeping prices stratospheric even as their costs deflate? Keep watching, because the truth might just change how you spend money forever. In the world of economics, there's a baffling disconnect that's leaving many scratching their heads. We're told that inflation is slowing, yet when we pull out our wallets at the grocery store, fill up the gas tank, or pay our rent, the numbers seem to tell a different story. The prices of these everyday items, these routine expenses, have skyrocketed and show no signs of returning to their previous modest levels. Consider the grocery bill for a typical family, which has surged by a startling 20% in the last year alone. Or take a look at the cost of gas, which has risen by an eye-watering 30%. And let's not even get started on rent in many cities. It's gone up by a jaw-dropping 40%. These aren't just numbers, they're real-world examples of the financial stress that many people are facing. The disconnect between the official inflation numbers and the reality we experience every day is causing a great deal of anxiety, pessimism, and even anger. Research shows that the majority of Americans are feeling the pinch, with more than half reporting that they're worse off financially than they were a year ago. That's a stunning statistic, and it paints a clear picture of the struggle many people are facing to make ends meet. So what's going on here? If inflation is slowing down, why aren't we seeing a decrease in prices? It's a complex issue and there are several factors at play, but at the heart of it is a concept known as sticky prices. The idea that once prices go up, they're reluctant to come back down. But why are prices so stubbornly high? And what can we do about it? Over the next few minutes, we'll delve into these questions and more as we explore the disconnect between inflation and high prices. So even though the inflation rate is slowing, why aren't we seeing a decrease in prices? It turns out there are a few reasons why prices aren't dropping as fast as inflation is, and one of the main culprits? Company pricing power and profit motives. In a nutshell, companies have the ability to keep prices high due to what economists call inelastic demand for essentials. This means that no matter how high the price goes, people still need to buy these goods. Think food, gas, medical care. When demand is inelastic, companies have less incentive to lower prices, even when their costs go down. Let's take the pharmaceutical industry as an example. With only a handful of major players, there's little competition. This allows these companies to charge high prices for essential medications, knowing that consumers have few, if any, alternatives. And it's not just the pharmaceutical industry. The same phenomenon can be seen across various sectors, from tech to utilities. As long as there's little to no competition, companies can maintain high prices without fear of losing customers. Now, you might be wondering, but wouldn't companies want to pass on cost reductions to consumers to increase their market share? Well, not necessarily. While this might be a viable strategy for some, many companies prefer to keep their prices high and pocket the difference as profit. This is especially true in industries with high concentration and little competition. For evidence, look no further than companies' profit margins. Over the past year, many companies have reported record profit margins, indicating that they're not passing on cost reductions to consumers. It's a clear sign of their pricing power. So while businesses enjoy higher profit margins, consumers are left grappling with high prices. It's a tough pill to swallow, but understanding the dynamics at play can help us navigate this challenging economic landscape. After all, knowledge is power, right? There's another factor at play here, something economists call the money illusion. This is a psychological phenomenon where people think of the nominal value of money rather than its real value. In simple terms, we tend to see the face value of money as constant, even when its purchasing power is changing due to inflation. Let's dive a bit deeper. Imagine you've been buying your favorite latte from the local coffee shop for $4 every day for the past several years. One day, you walk in, only to find out that the price has jumped to $4.50. Even though it's just a 50-cent increase, you are left feeling a sense of shock, and perhaps even betrayal. Why does this small change feel so significant? Well, that's the money illusion at work. After years of stable prices, even a small hike can feel like a punch to the gut. It's like a mental anchor has been lifted, leaving us feeling adrift in a sea of rising costs. And it's not just about the numbers. The money illusion triggers an emotional response. We feel the pinch more acutely because we perceive it as a loss. Our brain is wired to react more strongly to losses than to gains, a concept known as loss aversion. So the joy of getting a raise or finding a bargain is often overshadowed by the distress of paying more for the same latte. This psychological quirk is not limited to coffee, of course. It applies to everything from groceries to gas to rent. As prices continue to rise, the money illusion amplifies our sense of financial stress. It's a constant reminder that our dollars are not stretching as far as they used to. The money illusion can also fuel public anger and frustration. As we struggle to keep up with rising costs, it can feel like we're running on a financial treadmill, always moving, but never getting ahead. This can lead to feelings of resentment, especially if we believe companies are profiting at our expense. This psychological effect of inflation is contributing to the frustration and anger many consumers are feeling. But what about deflation? Isn't that when prices go down? Well, yes and no. You see, deflation and disinflation, though similar sounding, are two quite different things. Let's break it down. Disinflation is when the rate of inflation slows down. Picture a car easing off the gas pedal. The car is still moving forward, but not as quickly. In this analogy, the car represents the economy, and its speed is the rate of inflation. So, when we're experiencing disinflation, prices continue to increase just at a slower pace. Now, deflation, on the other hand, is when prices actually decrease. Going back to our car analogy, deflation would be like the car going in reverse. This might sound like a good thing, right? Who wouldn't want to pay less for their groceries or their morning coffee? But, in reality, deflation is quite rare and can signal a struggling economy. Consider the Great Depression of the 1930s, a period marked by deflation. During this time, prices dropped because demand drastically decreased. People were either out of work or afraid they might soon be, so they stopped spending. This led to a vicious cycle where businesses had to slash prices to try to lure customers, which in turn reduced their revenue, leading to layoffs and even more reduced spending. You see, when deflation sets in, it can be a tough cycle to break. That's why central banks and governments around the world try to maintain a small, steady rate of inflation instead. So, in our current situation, while inflation rates are slowing down, we're experiencing disinflation, not deflation. Prices are still going up, just not as quickly. And although disinflation can provide some relief, it doesn't necessarily mean that prices will drop back down to where they were before. So while we are seeing disinflation, we're not likely to see deflation, which means prices may remain high. Don't get discouraged though. In our next scene, we'll discuss some practical strategies you can use to manage these high prices. Stay tuned. So what's the outlook for the future? Are we stuck with these high prices forever? It's a question many of us are grappling with. Expert economists shed some light on this. They believe we're likely heading towards disinflation, not deflation. That means while the rate of inflation may slow, we shouldn't expect a dramatic drop in prices anytime soon. But here's the catch. Certain areas like rent, wages, and consumer debt levels could create pockets of persistent inflation. Rent and wages, once they rise, rarely come back down. And high debt levels can put pressure on prices, as businesses strive to keep up with their obligations. The road ahead is not without its bumps. The balancing act between keeping costs down and maintaining profitability is a tough one for businesses. As consumers, we may need to buckle up for a bit of a ride. It seems that affordable living will remain a challenge until a new equilibrium is reached. While we wait for lasting relief, there are proactive money habits you can adopt to ride out the turbulence. First, consider meal planning. This not only helps you avoid impulse buying, but it also allows you to make better use of leftovers, reducing waste and saving money. Next, shop strategically. Look for sales, use coupons, and don't shy away from store brands. They often offer the same quality as name brands at a fraction of the cost. Negotiating your bills is another effective strategy. Many service providers, from internet companies to insurance agencies, are willing to discuss rates if it means keeping you as a customer. Lastly, prioritize building an emergency fund. Start small if you need to, but aim to save enough to cover 3 to 6 months of living expenses. This will provide a safety net, helping you weather unexpected costs without going into debt. Navigating this economic landscape can be challenging, but with these strategies, you can take control of your spending and manage the high prices effectively.